Looking at the state of the global economy today, many may ask what exactly the central banks of their country do. After all, when we hear about all these interest rates and how they may be disestablishing the economy, so much so that they are often mentioned when it is time to dig the nation out of an economic crisis. Heck, sometimes they are even blamed for it. Suffice it to say, these central banks control your financial future and they don't need your permission to do so. Join us as we take a look at the role of central banks in the economy. Central banks. At the root of it, it's fair to say that central banks are institutions that are put in place in countries all over the world so that they could oversee and monitor the monetary system of that country. As such, you can see how they manage the supply of money in any given country. With measures available to them, such as the ability to manipulate the interest rates of the country, they would be able to maintain the stability of the financial system of their nation. If we take a look back in the annals of time, you'd find that these central banks were originally put in place so that they could give governments the funding they needed to maintain the value of the nation's currency. As time went on, we began to notice that the role of these central banks transformed into an institution that could regulate inflation in a bid to encourage the economic growth of the country. Again, you can see how the central bank of a country proves to be a stabilizing force, especially during times of financial crises. Tools available to the central bank. As we've hinted at already, the central bank of a country will need certain tools to make sure that the economy of a country is in a safe place. Let's take a look at some of these tools. Interest rates policy. This is perhaps the most well-known tool available to the central government of any given country. With this tool, the central government can manipulate the economy of the country to suit the needs of the people at any given point in time. You'd find that when interest rates are reduced or lowered, more people may feel encouraged to borrow money because now the rates of borrowing the money are cheaper. This in turn would create an environment that encourages more spending and investing. On the other hand, you may find that a central bank may increase the interest rates when they notice that people are borrowing a bit too much for their own good. By raising the interest rates, you find that it would reduce the rate of spending and borrowing in a way that would help the economy cool down. Open market operations. Another way a country can monitor or regulate its economy is by buying or selling government securities in the open market. That way, you could say that they could directly affect the supply of money in a country. By purchasing securities, for example, you may find that they are able to inject money into the banking system of the country. As a result, you'd see that this would encourage growth when it comes to lending and investment in the country. On the other hand, you'd find that if they want to control the rate of inflation in the country, the central bank could do so by selling these securities. What happens if a central bank makes a wrong move? That could be one of the worst nightmares any country could make. If you find that one of these central banks has adopted the wrong monetary policy move, you'd see that said country would be suffering from a wide range of negative economic issues. High inflation. One of the things that could happen if a central bank of a country has made the wrong move is that it could trigger what is referred to as high inflation. Here, you could get this effect if that central bank kept the interest rates a bit too low. In such a situation, you may find that the increased demand for the money overcomes the supply, thereby resulting in the rapid rise of the cost of goods and services in the country. You better watch out for that high inflation. Currency depreciation. Another side effect of a central bank taking the wrong steps is that it could lead to the irreparable depreciation of their currency. This is terrible because this could do anything from raising the prices of goods and services to even causing a negative ripple in the global financial landscape. Show me a country that has a weak currency, and you can be sure that his country is a country with a weak central bank. Financial instability. As you can imagine, a country where the central bank has made some bad moves will be a country with weak currency and high inflation. It could also be a country that is having to deal with economic and financial instability. Just think of a situation where the central bank is in too much debt, or if they had mismanaged their risk. Such a central bank is likely to create a situation where the country could be plunged into financial crises that it may never recover from. Just look at Zimbabwe, for example. After printing money excessively in the 2000s, hyperinflation brought the country to its knees, so much so that the country has not recovered till this day. In conclusion, the central bank of a country plays a vital role in keeping things going in a country. Thanks to its ability to regulate interest rates and the availability of securities to trade, they could make sure they keep a country afloat. However, one false move and they could plunge a country country into the depths of poverty that it may never be able to recover. Let's just hope that these central banks are making the best moves for their country.